Ferrari will report results this week, and to prepare, we're going to take a look at our earnings model. If you'd like to download this model and follow along, please visit our website, gutenbergresearch.com. Click on the Free Models tab and scroll down to the Ferrari model. Let's see, right here, you just click the button and it'll download. And if you're new to our approach, from the home page, you can click on this thumbnail and it'll give you our updated document which provides our full financial modeling and equity valuation approach. So this time around, we actually have not calibrated our model to meet consensus estimates, and that's because, one, there aren't too many analysts covering the stock yet since it's only been public for a little over a quarter, and two, the company reported some summary results for Ferrari as part of the FCA group filing that was issued last week, and the consensus estimates for the December quarter do not actually meet those metrics that were published last week. So some of the analysts haven't updated their results, and as a result, it doesn't really make sense to try and calibrate the future periods to consensus estimates. This quarter will be important because we're going to get our first view of fiscal year 2016 expectations. So we think the most important thing here will be the shipment guidance for the full year. And we know that it's going to be negatively impacted by the end of the life cycle of the 458 Italia and 458 Spider, but the company should get a boost from the 488 GTB and California T. And the F12 will also be included in 2016's guidance, but keep in mind that production is limited to just 799 cars, and they were already pre-sold as of last quarter, so that's probably not going to add much of a boost to shares. Let's take a look at the results that we got back from the FCA group filing last week. So they give us three metrics. They give us net revenues, adjusted EBIT, and net profit, all in euro. So if we go over to our model, net revenues came in at 685 million euro, which was below expectations. Fine. We adjusted our average selling price per vehicle and our shipment growth rate both downward slightly to get to that $685 million target. Then on a EBIT basis, they give us non-GAAP EBIT, but we think that disclosure was really just because they were showing period over period results, and in the past they've had some non-GAAP adjustments related to the IPO. So there may be some new non-GAAP adjustments, but we don't think there should be any costs associated with the IPO at this point. So for right now, we left that at zero. Then the interesting thing is how they got to net income of 55 million euro from EBIT of 109. So we only have three line items below the EBIT row. We have net financial income and expense, income taxes, and net profit attributable to non-controlling interests. So we had to increase our net financial income. So you can see here we're back to about the levels we had at June, although on a lower revenue base, so really a higher percentage of total revenue. Then we had to bring our income tax expense way up. So in the past quarters, we were at around 33.5%. We had to bring it up to 42.7%. And this is sort of the part that we're scratching our head, how they get back to this 55 million net income. And at the same time, the net profit attributable to non-controlling interest, we had to increase that as well. So we really need to have a better understanding of what exactly went into this net income number, and if there are any additional adjustments or one-time items that are going to be reported in this fourth quarter. From there, we'll have some better idea of how to model earnings going forward. For now, our model is actually pretty simple. We show the breakout by revenue in euro based on each region. We show a total shipment rate on a quarter-over-quarter basis and average revenue per shipment, so average revenue per car. And then we break out the other revenue items, so engines, sponsorship, and other income, and we show that on a quarter-over-quarter growth rate basis. And then we do our basic OPEX items, effective tax rate, and other items here. And if they do start to report adjustments to non-GAAP income, we'll put those in these rows here. We show the adjusted EBITDA and the change in diluted shares, and then of course we're doing our separation of equity value from cash value, so that's why we have this section down here. So it's still pretty early. They have only been public for about a quarter. So if you guys have any ideas on how you'd like to see us model earnings, please throw those ideas in the comments section, and we'll take them into consideration and think about how we want to do this going forward. And if you're interested in financial modeling, please subscribe to our channel, and thanks for watching.